Welcome to chapter 2. Today we're going to be focused on the introduction of what we call job order costing. You're going to learn about that in this entire chapter. Um, and there's a whole bunch of cost systems that you're going to be learning about. This is the first one. Okay, so we're going to start with the intro here. Remember, part of accounting is measuring and recording and reporting costs, and that's the focus of cost accounting. And it's a very important thing because businesses have to know their costs. Otherwise, how do you price your product well? How do you make a profit? It's incredibly important. Okay. There are two different basic types of systems that are used for uh, for costing out a product. The first one is called a process order cost system, and the second is a job order cost system. Obviously, this chapter is focused on that, but they do sort of give you a basic introduction of the process cost system. So basically speaking, when you have a large volume of a similar product that's getting spit out in manufacturing, like cereal, um, or gasoline, or even large batches of ice cream, um, you would probably want to use the process cost system. Okay. And these costs are accumulated over a period of time. So it's either a week or a month. And then they are assigned to various departments or processes over that time period. Okay. So the best way to illustrate it here is with potato chips, and who doesn't like potato chips? Um, this is a this is the same system, and the product is produced in mass quantities. Okay, so you start with your raw materials and the processes in which to get that ready, including cleaning and slicing. Then they go through the system where they're cooked in oil. They're dried and they are bagged. And this particular system works regardless whether even at this point or at this point they might be adding flavors to the chips or not. It's simply the same process over and over again. So this is where a process cost system would be most utilized because it's relatively easy to see that this is a simple process. Same would be true with like ice cream or cereal. Okay. But a job order cost system works a bit different because now we're looking at the costs for each job. Or if you're looking at it, you can look at it from each batch of goods that you're producing. Okay. So it's important to know you can only use a job order cost system when each job has its own distinguishing characteristics. And we're going to talk a little bit about that in a moment. So the objective here is to compute the cost per job, Okay. And so we measure cost for each job and not for a time period, like we would with the potato chips. So here is an illustration of recording costs through a job order cost system for a company like Disney in producing two separate films. So two separate films would mean one film is job 9501, the other film is job 9502. They're distinguished in that way. Okay. One job might be, this might be an animated film. So it has its distinguishing characteristic here. And this other might be an action thriller. Okay. And so for each film, there are just different things that are going to be needed. Okay. So for the animated film, you need the talent, the voiceover talent, computer programmers, etc. Each of these have to be costed very specific to this specific animated film. That's the purpose of a job order cost system. It's a specific job, it's a specific film. So all the costs are being measured specifically for that film. The same on the other side here, where you have an action thriller, where you actually have actors and stunt folks, and you need sets and designs, and plus you need all the the backstage type of stuff, location fees and insurance and all this other stuff. Each of these need to be looked at as cost specific to this particular film. And so a job order cost system would be able to say, okay, these are all of the costs related to this particular film. Okay. And so that's basically how a job order cost system differs from one of those, like from potato chips, and creating potato chips. Making me a little hungry. All right. I do like the stories in this book. I mean, it's different than the financial accounting where I read a story or two, but nothing terrific. These are great stories here. So one of the biggest problems with this is many companies actually suffer from poor cost accounting systems. They just don't know their costs, which is a huge problem, huge problem. So there is a company here that they rebuild diesel locomotives, and they thought they were making money. They thought they were profitable. The problem was the company underestimated all of their costs. Okay. And it wasn't a moment too soon because they were losing money. For every locomotive they sold, they lost a ton of money. It's funny how the managers thought they were making money. Well, the managers didn't know really what their costs were of rebuilding the diesel locomotive. They didn't have a system in place to look at it. And so in essence, the more contracts it won, the more money it lost. The more it was doing business, the deeper into the hole they were getting. And they didn't realize it for a long time. So costs are important. They are critical, right? All right, so we're going to be looking at the flow, okay, job order cost flow. Basically, it parallels the physical flow of the materials as they go from raw materials into finished goods. Okay, so you have manufacturing costs, which you already know how to calculate from chapter 1. These are going to be assigned into what's called a work in process inventory account. Okay, because everything's going to start there. Of course, these are work in process, so these products are being worked on. What happens when they're done being worked on? Well, then those products, those jobs that are completed will go into the finished goods inventory account because those are finished goods. They're ready to be sold to other businesses, to customers, right? So when those units are sold from the finished goods inventory account, now they can be transferred to cost of goods sold. So this flow is what you're going to be working on in this particular chapter, part of the chapter. So this is the illustration, and I love this illustration. Look, that's a beautiful flow. So everything starts with all those manufacturing costs that we looked at in chapter 1. Raw materials, factory labor, and manufacturing overhead. Okay. This is the start of the manufacturing. Once they start, then once they start actually putting the product together, in this case, this is a fire truck. Okay. Well, fire trucks that are in process look quite unfinished. Okay, because they're still in process. So as work gets done, it gets put into the work in process inventory account. Okay. Once it's completed, it looks like a fire truck, and thus this particular company is ready to have that fire truck available to sell to customers. So it's going to be part of their finished goods inventory. Once they actually sell it to the customer, whatever customer buys fire trucks, they will put that money into their cost of goods sold. Okay, showing that it's done. So this illustration is really critical in understanding what we're doing here. Okay. And it's important for you to know what each of these particular steps are and what they mean. Okay. All right. So here's an illustration. And if you have your book handy, these illustrations, I think, begin on page 50. Yeah, page 50 and 51, if you have a physical book with you handy. If not, I'm going to give you the link anyway, so no problem. So here is an illustration with a company that we call Wallace Company. Okay. They had purchased 2,000 lithium batteries at $5 per battery. So $10,000 of lithium batteries. They bought 800 electronic modules at $40 a module, so 32,000 in modules. So their total cost was the $10,000 of batteries and the 32,000 of electronic modules, or $42,000 total cost. So what would be the entry that Wallace Company would do to show that they purchased these? Well, assuming the date is January the 4th, which it is, they are going to debit their raw materials inventory, because the batteries and the modules are their raw materials. They're going to debit raw materials inventory by $42,000. Okay. And of course, they're going to credit their accounts payable. And so basically speaking, that would be the start of our accounting in the manufacturing process. Raw materials first. The next thing we would look at are factory labor costs. Okay. So factory labor costs really are about three things: the gross earnings of the workers on the factory floor. So that's one. The employer payroll tax that they have to pay on those earnings. Remember, whatever you see coming out of your check for Social Security and Medicare, your FICA tax, in other words, your employer is paying that as well, separately. So it's a double pay on your behalf. So those are employer payroll taxes on those earnings. And any fringe benefits like sick pay, pensions, vacation, whatever, that the employer needs to pay for that. So these are all factory labor costs, and these are going to be recorded as well. So let's go back to our wonderful company at Wallace, the wonderful world of Wallace here. They incurred $32,000 of factory labor costs. Okay, that's the total. 27,000 is their wages payable. 5,000 is payroll tax payable, and this happened in February. So what would the entry look like in a journal? They would debit factory labor by 32,000. I said 32,000. And they would credit their factory wages payable, because that's the wage payable, for 27,000, and their employer payroll tax payable for 5,000, because they will be paying that this at the next pay date, whatever their pay date is, and this when they're sending money into the government as well. So these would be the factory labor costs that would go next. So we calculate material first, then we calculate factory labor second. Okay. Overhead third. Okay, because these are total manufacturing costs, right? So overhead, as you learned from chapter 1, basically there are many different types of overhead, like property taxes on a factory, depreciation and insurance, any repairs. Plus there are other types of things that are expense that are related, okay? And so the manufacturing overhead account is also part of that work in process, because you need raw materials, labor, and manufacturing overhead to get anything done. So this is how it would look for for Wallace Manufacturing Company in an illustration that's provided for you at the end of January of this month. They have debited the manufacturing overhead $13,800 because they had utilities payable, they had prepaid insurance, they had repairs, they had accumulated depreciation, and they had property taxes. All of these are, in essence, manufacturing overhead costs. And so manufacturing overhead would get the entire amount debited to its account. And you're going to see this repeated over and over and over again. So this is a very good, nice way to start. I'm kind of drifting you into it easily, believe it or not. Okay, so we're going to look at KRT Company, and they have the following costs. They have raw material purchases of $4,200 on account. They have factory labor of $18,000. Of that, $15,000 is wages payable, $3,000 is the payroll taxes. And they have a whole bunch of overhead, utilities and insurance and depreciation are all listed here. So learning objective 1, the do it exercise, basically summarizes those journal entries that they showed you in the last few slides. So one at a time. Raw materials, the raw materials account inventory is going to be debited for $4,200, and accounts payable is credited because they purchased these on account. You're going to have to pay for that later. Factory labor is going to be debited by the $18,000 full amount, of which $15,000 is wages payable, and the other $3,000 is their payroll tax payable. And the last thing that they want you to do is make sure you understand all of these are part of manufacturing overhead. Manufacturing overhead is going to have the debit for $7,500, and that includes the utilities payable of $2,200 credit, prepaid insurance, $1,800 credit, and accumulated depreciation of $3,500 on the credit side. That's how it all balances. So now we're back to the big room, and I'm open for questions.